Africa is a continent open to possibility, which comes to life when those with ambition and courage find the right partner, a partner with the tenacity to stand by them and light up a continent. With the experience and unique insights to go beyond limits, Absa Group Limited is that partner. We are synonymous with stability, transparency, and innovative thinking in financial services based on a legacy of 100 years of seamless execution across Africa. Our new brand and growth strategy define how we are shaping our destiny as a proudly African bank, inspired by Africanacity. This is the distinctly African ability to always find ways to get things done. Africanacity is what drives us, what sets the tone for our business, and echoes across our African footprint. Our corporate and investment banking business challenges limits. We close distances, connecting people to opportunities across borders, languages, and cultures. With global connectivity and local differentiation, we operate at the core of your strategy. Our understanding of each unique environment across regulatory and market practices results in a differentiated service and experience for our broad range of clients. Backed by insights into key sectors, we turn risks into opportunities, supported by a unique set of solutions that work across your full value chain. Our clients experience a seamless partnership across Africa, with aligned delivery positioning you for success across operating environments. Because African ingenuity and tenacity go beyond limits, so do we. Our world-class service is based on skills and expertise that have been developed to put our clients first, proven by numerous high-profile deals and coveted international awards. We are brave, we are passionate, we are ready. We are independently African, and we believe in building courageous partnerships that work. When you have the bravery to imagine and the will to get things done, that's Africanacity, that's Absa. Corporate and Investment Banking.
This is David Marsh from OMFIF. I'm the chairman of OMFIF, and it's a great privilege for me to launch this fourth index that we're producing with our friends from Absa. It's been a brilliant success so far. This is the fourth time we're doing it. So last time we were in Washington, before that we were in Bali, before that we were in Washington. This time we're doing the whole launch virtually. So it's a great problem that we can't actually see our friends physically, but we can see them virtually on the screens. Normally we have a really good launch whereby we have lots and lots of people in a ballroom. Now we have hundreds of people now connecting with us virtually. And so this is one of the pleasures of this launch, which has got a lot of meat to it, a lot of signs of how Africa has been advancing despite the problems that have been inflicted by the COVID crisis. So my first job is to introduce Daniel Minelli, who of course you will all know because he was for many years the Deputy Governor of the Reserve Bank of South Africa, has been since the beginning of the year the Chief Executive of Absa. And I really want to say Absa has gained a great new stalwart Chief Executive with you now, Daniel. And I would be very pleased if you could say a few words just to introduce this report. You know something about the report before because you've attended some of the Absa launches in the past. Please, Daniel, over to you to say a few words and to introduce also Tobias Adrian after that. The whole show will go on for about an hour and a half. We've got several really good speakers, including Jing Dong Hua, and now at the World Bank. Great pleasure and privilege, Daniel, to introduce you now as the new Chief Executive of Absa. Daniel, the floor is yours.
Thank you very much, David, for the kind introduction. Good afternoon, ladies and gentlemen, and a special welcome to our distinguished guests from central banks, ministries of finance, development finance institutions, from stock exchanges, regulators from across the continent and beyond. Thank you very much for joining us today. for the launch of the 2020 Absa Financial Markets Index. As David has just said, this is the 4th year that Absa has partnered with OMFIF to produce this report. And this is a partnership, David, of which we're very proud. And the partnership started in 2017 after we recognized the need for greater insights into the state of financial markets on the African continent. Africa's large and dynamic markets present above average opportunities for growth, yet investment prospects for both international and local investors are hampered by underdeveloped financial markets and in some instances, not yet sufficiently developed legal and regulatory frameworks. Expanding and deepening financial markets across Africa is a central condition for the next stage of the continent's economic success, and this will be best served with markets that are open, that are transparent, accessible, and smartly regulated. The Absa Africa Financial Market Index seeks to boost the development of the continent's financial markets by providing a clear measure of where various countries are today, highlighting positive examples that can be used elsewhere to fast-track progress, and by encouraging discussion amongst policymakers, market participants, investors, and regulators. Sound financial markets rely on investment. This index provides stakeholders with an understanding of the strengths and weaknesses of the markets that are surveyed, and provides countries with a metrics that they can use to broaden and deepen their financial markets, making them more attractive to investors. The index gives us an opportunity to demonstrate to senior stakeholders and influencers across the continent and the world that we maintain our commitment to the African continent. Absa has a presence in 12 countries across the continent, and we have an ambition to be a financial services group that Africa can be proud of. We are committed to the growth of this continent and the prosperity of our people, and believe that bringing these kinds of insights is our contribution to the reforms and policy discussions that need to take place on our continent. We are pleased this year that the number of countries surveyed increased by 3 to include Eswatini, Lesotho, and Malawi. This index has now grown to 23 countries surveyed from 17 when it was launched in 2017. I now have the great pleasure of introducing our keynote speaker and extend a very warm welcome to Tobias Adrian. Tobias is the Financial Counselor and Director of International Monetary Fund's Monetary and Capital Markets Division, a former colleague before I was privatized last year. Tobias leads the IMF's work on financial sector surveillance, monetary and macroprudential policies, financial regulation, debt management, and capital markets. And this includes the publication of the extremely well-researched and most informative Financial Stability Report, the latest edition of which was released just yesterday. He also oversees the capacity building activities in IMF member countries. And prior to joining the IMF, he was a senior vice president of the Federal Reserve Bank of New York and the associate director of research and the statistics group there. Tobias, I know that during the time of annual meetings, whether virtual or real, your diary is extremely busy, and I thank you very much for agreeing to be with us today. And without further ado, hand over to you. The floor is yours.
Very good to see you, Daniel. Thanks for the kind opening remarks. Good to see you, David. Thanks for having me. And greetings from Washington, D.C. So this is the second time that we have the meetings virtually after the spring meetings, now the annual meetings. And indeed, the good thing is that we can connect virtually with colleagues and friends around the world. So I'm very excited to be with you today and to share some of our thinking about stress in emerging markets, and in particular, I'm going to focus on local bond markets. Those are particularly important for financing for countries around the world and emerging markets around the world. And I want to look a little bit at how these local bond markets have fared in this crisis. So let's go to the next slide. Yes, here we are. So the left chart shows you an index of market stress that has two components. One is the local bond market stress index in yellow, and the other one is an FX stress index, which is in red. So the two indices together show that stress in emerging markets was at very high levels, nearly reaching the levels of the global financial crisis. But the composition of stress was slightly different than in the past. So the local bond markets were more stressed than the FX component in this crisis. And so in this presentation, I'm going to explain a little bit what is behind these indices and what are the drivers in this COVID crisis. So the good news is that the stress has abated to a large extent. And so the right-hand chart shows you in particular how the local stress index has evolved this year for emerging markets that have deployed asset purchase programs. So many emerging markets, of course, have used asset purchase programs for either market functioning purposes or for the goal of easing financial conditions for the first time. And you can see that those countries with asset purchases have seen a somewhat quicker reduction in the stress of local bond markets. So the kind of indicators that feed into these indices are not your typical financial conditions indicators. So we're not looking at funding spreads or credit spreads or the cost of capital or equity markets. What we're looking at here are things that are more related to market liquidity and funding liquidity indicators. So these are like bid-ask spreads, volatility, risk reversals, and basis. For the FX stress index, it's the cross-currency basis, for example, and for the local bond market index, it's the asset swap basis. So these are indicators of either market liquidity or funding liquidity, and they tell you to what degree you can transact at cheap prices in either the FX component or the local government bond market component of the stress index. And so again, what is distinguishing this year is that it's the local government markets that saw quite a bit of stress, but the good news is that that stress is abating very quickly, much more quickly than in the 2008 crisis. So what is behind the run-up and the quick reversal of these stress indices? So let's turn to the next slide. So on the left chart on this slide, we are looking at monetary policy around emerging markets, and the right chart is looking at fiscal policies. And the amazing thing this year has been the very fast and very aggressive policy action by both central banks and finance ministries around the world. So the left chart shows you policy rates for emerging markets together with a range from 2005 to 2019. And you can see that compared to the policy rate as of the end of 2019, there has been a cut in every single emerging market here, and rates now are lower for pretty much all countries. I mean, the exceptions here are Turkey and Mexico, but for all other countries, the policy rates are either at the lower end or below the range for the 2005 to 2019 interest rate range. And so monetary policy has been very aggressive at easing. And that's somewhat different than in the 2008 crisis, where emerging markets actually waited quite some time before easing. So this time, emerging markets went in very quickly at easing. And so what is the difference relative to earlier episodes? I think there are two differences. So one is that this shock was deflationary for emerging markets around the world. So aggregate demand dropped, but also commodity prices dropped. And so, inflationary pressures were relatively low, or there were inflation pressures downward in most countries. So that gave the room for monetary policy to act. And secondly, the exchange rate was used as a shock absorber in many countries. So emerging markets allowed the exchange rate to depreciate, and that acted as a shock absorber and ultimately got capital to flow back in at the new exchange rate. So those are two distinguishing features in this crisis, and I think they are really testaments to good policy frameworks. The other thing, of course, that happened is an aggressive fiscal policy response. And the right chart shows you that just the magnitude of the policy response of emerging markets is much bigger in this crisis than back in the 2008-2009 crisis. So very quickly, fiscal transfers, credit guarantees, and temporary tax relaxations were introduced in order to support the corporate sector, the banking sector, and the household sector in this terrible crisis to get through this, because of course the pandemic is expected to go away at some point, and we do see a slight recovery already in some countries. So let's turn to the next slide. Let me turn back to the importance of the local currency bond markets. The left chart shows you that globally in emerging markets, there was a huge expansion of local currency bond markets between 2007 and 2012. That went from about 100 billion to close to 700 billion. And that it has stalled somewhat since then, but you see that many emerging markets around the world, including South Africa here in sort of pink, really expanded the local government bond market. And of course, that's a great source of stability as a funding source. And as I said earlier, there was a lot of stress in that market, but that stress is abating thanks to both the central bank actions and the fiscal actions. Now, having said that, local debt turnover has come down a little bit. So we are somewhat concerned in terms of the development of these markets. And I think both for the private sector and for the public sector, the further development and the further institutionalization of the local government bond markets is going to be a priority going forward, coming out of this crisis. So let's turn to the next slide. So here I wanted to take a closer look at South Africa in particular. So first, I show you the decomposition of the FX stress index for South Africa. And on the left panel, I show the global financial crisis stress index compared to the COVID-19 crisis of 2020 on the right chart. And you can see that the FX stress actually was much less in 2020 than in 2008. So 2008 was more of a stress in the FX markets, and the particular contributor there was the correlation. Correlations went up in the global financial crisis in FX, in terms of FX correlations, and much less of that happened in the 2020 crisis. Furthermore, of course, the FX basis, right, the cross-currency basis widened in March, but then very quickly the Federal Reserve and other central banks started to extend these FX swap facilities, and that contained the widening of the basis, and actually the FX swap basis returned back to more normal levels pretty quickly. And you can also see, that realized volatility went up, and it's still somewhat elevated. So we have seen, a pretty quick return to more normal conditions in terms of FX stress. We're not fully returned to pre-crisis levels, but we are a long way there. And again, the adjustment of the exchange rate has helped in terms of relieving the liquidity stress that is measured here by this local stress index. So now let's turn to the next slide, and we stay with South Africa here. And so this is looking at the local government bond market in South Africa. And there you can see that the picture is the opposite. So while in 2008, the local government bond market was not that stressed, this time it is very stressed. And that is particularly so as the correlations have gone up in this crisis. So some of the diversification benefits for an investor of being in local government debt in South Africa has gone away because of the rise in correlations. And that's a broader theme that we observed around the world, where correlations really have increased sharply in this 2020 crisis. But on the other hand, the other indicators such as the asset swap spread, the bid offer spread, and other indicators actually have returned. And so the stress in local bond markets is returning to more normal levels, but it's taking a little bit longer than what we have seen in the FX markets. So with that, let me conclude, and this is finishing my presentation. So let me just conclude with a broader outlook of financial stability. So what we're seeing is that financial conditions broadly at the global level have eased, and that is really helping to support the economic recovery. Many countries can issue, and many corporations can issue in global bond markets, either in sovereign bond markets or in corporate bond markets. And especially at the investment grade level, the funding conditions are relatively easy in terms of levels of yields. Now, having said that, in frontier markets and in many African emerging markets, funding conditions do remain tight. And we do hope that further policy actions are going to ease funding conditions there as well to help the recovery from this terrible pandemic, which has caused a very deep economic crisis. But the good thing in this episode is that we're not looking at the global financial crisis at this point, right? So the banking system went into the crisis with much higher capital, and the central banks injected liquidity very quickly, so that despite a massive economic crisis and a massive health crisis, we don't see a financial crisis at the global level at this point. So with that, let me stop and let me thank you for your attention this morning.
Thank you very much, Tobias. I think your presentation has shown, if nothing else, how vital the smooth working of financial markets are. And I think we can be grateful for small mercies that, as you say, the markets are not seizing up, and some of the stress levels that you were pointing out have returned to what would be normally the case. So thank you very much, Tobias, for setting the scene there. Before we hand over to the colleagues at Absa and my colleague Danai from OMFIF to take us through the report, I just want to introduce a new feature this year. It's a poll. We'd like to use our opinion poll facilities. Apparently there will be a poll appearing on your screen, all of you who are looking at this around the world. And it's a very simple yes, no. Has the COVID crisis fundamentally altered the African investment outlook for the next 5 years? Please just enter yes or no, and magically that will all be transferred into a result. We're then going to ask the same question of you in about 20 minutes once our friends and colleagues have finished the presentation, and then that is simply an experiment to see whether you are more or less gloomy as a result of the fabulous presentation that we will hear from our colleagues in the next 20 minutes. So if you wouldn't mind just filling in those forms, and then I'm sure technically we'll be able to see the result in a very short number of minutes, if not seconds. So please carry on filling those in, and then I would hope that the result will be appearing on our screen very soon. So you all had a little bit of time to cogitate on that, and hopefully you've come up with the right answers. And we should be able to get, it has fundamentally altered the African investment outlook. We'll probably find out in what direction it has gone, we would hope. That's one of the issues that is still remaining slightly open. But anyway, we'll ask the same question, whether there's more or less uncertainty. We'll ask the same question again in 20 minutes. So it certainly shows there's a lot of uncertainty around and people are looking for answers to the questions. So who better to give the answers than the three people I'm going to introduce now to take you through the granular detail of this year's report. That is Jeff, who is a well-known person to you all, Jeff Gable, who is the chief economist, George Asante, who is the head of markets outside South Africa for Absa Bank. And then we also have Danai Kirakopoulou, the OMFIF chief economist, who's been one of the several OMFIF colleagues who's been behind the report. So Jeff, first of all, over to you in Joburg to take us through the report. Jeff.
David, thank you very much for that introduction and for all the work that's been done on the report itself. I suppose as a start, just want to highlight that the African Financial Markets Index isn't an index about where the highest return has been or is likely to be. It's not about where the biggest need for capital is. It isn't about which country might in some ways be considered the most deserving either. It's not about global competitiveness or the ease of doing business. It's not about political transparency or social progress. All of those things are absolutely key. But when we look for a contribution to sort of the African experience from a financial markets perspective, our starting point here is that effective financial market development can best ensure that Africa is well placed to attract global capital, and maybe just as importantly, that Africa also encourages the effective use of its domestic financial assets as well. And so to do that, we believe that African regulators and policymakers, the exchanges, the providers of capital, and the users of capital are best served by a financial market ecosystem that's really characterized by openness, transparency, and accessibility. And so our strong conviction within that is that as Africa seeks to recover from the ravages of the global pandemic, the importance of effective financial market development and helping to ensure access to capital is going to be even more important going forward than it has been to date. And so as partners in this exercise, OMFIF and Absa, we look to provide sort of an information repository where countries can easily be compared, with which discussions, debate, and learning can be encouraged. And that as a collective, those within Africa and those with a great interest in Africa can sort of push this progress forward. So across the continent, as you will know, we've got an incredible range of countries, and the same thing is reflected in the index itself. We've got from fairly small island nations like Seychelles to the near 200 million people of bustling Nigeria. We have countries with very low per capita incomes and those that rank quite favorably in an emerging market context. So there's an awful lot of complexity and difference across the index participants. And so to encourage this discussion about financial market development, 4 years ago we launched the African Financial Markets Index. As we heard from Daniel a little bit earlier, it launched with 17 countries. In 2020, we've got that number up to 23. That represents about 2/3 of the African population and almost 80% of the GDP. So it is really getting to be quite a cohesive product in that space. The headline focus, I know for all of these index launches, is often not always in the detail. It's what's the who won, right? Who came first? So if we could change to the first slide, please. You'll see the overall scoring on page 7 of the physical report. And what you see there, if we just recount the top 3 places, South Africa has retained its top spot, notwithstanding very stiff economic headwinds that it faces. Similarly, this year, as with last year, Mauritius has maintained its second place. Nigeria is one of the exciting movers that we have in the index. It rises 3 places to take third in the 2020 index. And it's also a great example of where countries can perform pretty well in some parts of the index. Nigeria placed second in 2 of the 6 pillars that we measure, but also have plenty of room to improve. It scored last place, for example, in one of the pillars that we have. And notably, all 3 of those top 3 countries, South Africa, Mauritius, Nigeria, all 3 of those countries improved their scoring in the index in 2020 as compared to 19. 2019. And indeed, of the 20 countries that we'd also included last year, 14 of them managed to see their score rise, even in the very difficult environment that we have currently. Indeed, if we take a step back and want to highlight just sort of one of the other sort of quite pleasant sort of facts around this, in 2017, our scoring ranges from 0 to 100, 100 being the best possible score a country can achieve in the index. Only 6 out of the 17 countries we started with managed to achieve a score of 50 or above. And in today's 2020 publication, as you can see in front of you, 14 of our countries are at 50 or above. And in 2020 alone, we witnessed 9 of the countries improving their scores as compared to a year earlier. And again, that's in very trying circumstances. So that's really a very positive message. I'd also like to single out Ghana and Nigeria, Morocco and Seychelles as the 4 countries who saw the largest improvements in their scores for 2020. But before I hand off to a little bit more of the detail, I wanted to speak for a moment just how we generate the scoring itself. So as you might expect, and certainly as we quickly learned back in 2017 when we first designed the index, there's no clear and easy way to measure such an expansive idea as openness and transparency and accessibility of Africa's financial markets. But if we flip the page, you can see that the way we've organized ourselves in the data set here is around 6 main themes, or as we call them, pillars. And so there's market depth, access to foreign exchange, market transparency, the capacity of local investors, the macro environment, and then really the 6 pillars sort of around financial property rights. Danai and George are going to discuss each of these pillars in a little bit more detail in a moment, but what I wanted to do was just set a little bit of the broader scene here. And so in that space, there's more than 40 concepts that we measure. For some of the annual concepts, for some of them, the data, if it's available once per calendar year, our data edge would be the end of 2019. For other data that's available at higher frequency, the data cutoff will be around the middle part of the year. You can find a complete list of all of the measures that go into all of the pillars in the formal report on page 38 and 39. But to set the scene most broadly, some are very quantitative in scale. So for example, in pillar 4, where we're looking to measure the capacity of local investors, we look at the value of pension assets in the country per capita. So very quantitative, very scaled. Some of the measures we're looking at are quantitative, but have sort of discrete answers. So for example, in pillar 2, the scoring in the index rewards countries that have secondary market makers, frowns on countries that have varying degrees of capital controls. And some of the measures that we have are a little bit more qualitative. So for example, in pillars 3 and 6, we have index scores in relation to the legal, the regulatory, and the market conditions in various countries. But across the data set, I guess an important message here is that we're constantly looking to fine-tune our definitions and improve the quality of the data collection. And I'm really pleased to say that for 2020, we've had even greater participation and collaboration from the regulators, from central banks, from capital market authorities. And I want to make a very special mention to ISDA, who's come on board for 2020, providing data for the first time for some of our pillars. And that's been a really great addition. We can flip the page one more time. I'm also very happy to report that all of the data and all the detail that we're going to be talking about today is available for everyone to see via an interactive database on the web. So in this space, for any particular country and their overall score in the leftmost column, clicking on it will return sort of the score itself, the ordinal placing, and where it came from the previous year. Into the individual pillars, you'll drill down there into some of the sub-questions that exist. So there's really a huge amount of information available to everyone. Before I hand off, the last thing I want to do is also highlight that the value in the report is not just about the hard data itself, but also about the contributions from more than 30 individuals, spanning sort of C-suites and policymakers and other knowledgeable experts representing institutions across a huge array of official and private sector across the continent. And you're going to find those insights spread throughout the document. And it really helps give a greater flavor and clarity to the figures themselves, and really demonstrates in many cases just why this work and why financial market development can be so very important. But in any event, my time has now come to an end. I'm very pleased to hand you over to Danai and George to talk you through some of that pillar detail. Thank you.
Thank you, Jeff. If we can move to the next slide, just to go straight into the first pillar, which in many ways is the result of what all the other pillars are trying to do. So setting up the infrastructure in pillar one really shows us the result of what is the market depth in African financial markets. So it's made up of several indicators. We look at product diversity, so what kind of products are available on the stock exchanges, but also the size, liquidity, turnover, depth. What is the turnover? What is is there a primary dealer system, a secondary dealer system? We look at all these factors for different countries. And what's interesting about pillar one is that there is a very big gap between the first few countries and the rest. There is big inequalities in terms of the score. So you can see South Africa gets 100, and then the last country, Lesotho, gets around 11. So it's quite a big dispersion in scores, and only 3 countries get above 70, and then you have a big cluster of around 50 or down to 30 on average for the rest of the countries. So there's very big differences in this pillar. And when we look at what happened this year compared to last year, this is also the pillar where the impact of COVID-19 was felt the most. So on average, country scores dropped because of the reduction in liquidity, even though there were also some sell-offs which helped improve liquidity in some cases, also in the foreign exchange, as we will explain in pillar 2. But looking also at the top risers and fallers, so Seychelles, Tanzania, and Ghana improved their scores in pillar 1. Zambia, Angola, and Rwanda decreased their scores in pillar 1, but overall we didn't see that big differences in this pillar compared to previous years. If we move to the next slide, just to go in a little bit more detail about the market capitalization as a share of GDP, here you can see even more the big changes and the big inequalities that we see across countries. So you have South Africa, Botswana, and the Seychelles being the only 3 countries that have above 80% in terms of the share of market capitalization share of GDP. And then you have for the rest of the countries an average that is, for the majority of countries, is below 15%, and for quite a few countries it's below 5 or even 0%. So there's quite a big dispersion here. We saw quite encouragingly a shift in the Seychelles this year. So there is a rebranding of the stock exchange, the merge exchange, which led to the market capitalization as a share of GDP to rise from 21% to 89%. That is quite big, and as you can see here in the chart, we have the 2019 and 2020 levels, and you can see the big jump in the Seychelles, and it's actually one of the few countries that did not see a decrease in market capitalization share of GDP, the others being Malawi and Cameroon as well. Zambia was a country that saw a big drop, 2 places because of declines in market liquidity. There was also pressure on the exchange rate. It was a currency, the kwacha, fell by 40% in the period that we looked at, so quite a big decline and pressure in the currency. Similarly, also Angola saw pressure in the currency because of the oil price declines that we saw this year. So there was challenges for these countries. If we move to the next slide, here we summarize some of the exciting developments that we've seen over the past year in market depth in African economies. So there is a lot of innovation happening. Here you see some examples. So for example, the Stock Exchange of Mauritius opened its market to international central securities depositories. Tanzania saw a rise in equity market liquidity. Uganda is reforming its primary dealer system to enhance price discovery. There is also projects to help link stock exchanges. So the Africa Exchanges Linkages project, which is trying to link trading in regional bourses, and has started working with the African Development Bank on this. And also we heard from survey respondents, which as Jeff said, was also a source of information for this year's report, that there is foreign investors may have been less active in local markets this year because of COVID, and that may have hurt liquidity. There's also been a lot of other exciting developments in terms of market product diversity when it comes to sustainability, which is a theme that has been very present in African financial markets as well. So just to give some examples, Kenya and Nigeria issued sovereign green bonds, and Egypt as well. In the case of Kenya in 2019, this was the first green bond that the country issued on a sovereign basis, and same for Egypt. It was the first in the Middle East and North Africa region. Nigeria was its third sovereign green bond. We also had the African Development Bank issue a social bond, a Corona bond. We've been talking a lot in Europe about Corona bonds, but actually the AFDB was the first to issue that. It was a 3 billion bond. So we're seeing a lot of innovation also in the area of sustainability. And the South African Stock Exchange also is increasing its activities in terms of green products and focusing on that. We are also seeing innovations in terms of taking advantage of technology for enabling trading and building mobile platforms for retail investors, for example. Eswatini, Namibia, the Nairobi Stock Exchange and the Dar es Salaam Stock Exchange are all moving in this direction. And the Namibian Stock Exchange also listed its first bond ETF. So there's a lot of development there, a lot of innovation that we're seeing in stock exchanges in the different African economies that we monitor. If we move to the next slide and also to pillar 2. So that is a pillar that's looking at access to foreign exchange. So how easy is it for foreign investors to put their money in different financial markets and take it out as well? Because there may be a great macroeconomic opportunity, promises, but if foreign investors cannot feel confident that they can put their money in, take it out when they want to, they're not going to invest. So here we look at things like net portfolio investments to reserves. So how vulnerable are countries to foreign investors taking their money in and out. We're looking at the state of capital controls. We're looking at the interbank foreign exchange turnover. So how much is it that the central banks are managing this versus the private banks? Also the official exchange rate reporting standard. Is it that there is a unified exchange rate, or will investors see an exchange rate and then when they actually want to make a transaction, there will be something else? So here you see the example that Jeff also mentioned earlier about Nigeria, which is a country that scores very highly on the index as a whole, but in pillar 2 it's actually last. And that is because of the difficulties with the exchange rate reporting, which survey respondents said that it's something that they're looking to improve. So when we look at the top risers and fallers in this pillar, Ghana, the Seychelles, and Namibia improved the most. So Ghana saw a big jump of 5 places to 12th. Nigeria, Kenya, and Ivory Coast were the ones that deteriorated the most. Kenya is down 5 places to 10th place now, and notable also to say that back in 2018 it was the first scoring country in this pillar, so it deteriorated steadily and is now down to place 10. Ivory Coast and Nigeria also have deteriorated. If we move to the next slide, what explains these movements? So Ghana was the one that improved a lot, and that is because of a lower ratio of portfolio flows to reserves. Now that can be a difficult indicator to interpret, because on the one hand it means that you're more resilient, but on the other hand it's also good to have high portfolio inflows, and that can be a sign of being attractive to foreign investors. Higher interbank foreign exchange turnover, that is more straightforward, and that is something that for Ghana has been improving since 2016, when the country loosened surrender and repatriation requirements for exporters. Again, the net portfolio flows to reserves ratio dropped for Namibia, and that helped it lift it 2 places, and same for Seychelles, which lifted it 3 places. So Seychelles and Namibia have been improving on various pillars. Kenya, Nigeria, and Ivory Coast were down because of, again, the net portfolio flows to reserves. So this was a pillar where we saw more movement because of that, and that can also be attributed to the COVID-19 movement from foreign investors and how portfolio flows were affected by this. Looking at innovations and what may have changed on a more structural basis, so Angola at the start of 2020 introduced new rules to encourage oil companies to sell foreign exchange directly to commercial banks. And again, this is to respond to the oil price shock that I mentioned earlier, and the deterioration in the currency was around 25%. And again, Nigeria, even though it's scoring last, survey respondents said that there is a commitment to unify the multiple exchange rates. If we move to the next slide and pillar 3. So pillar 3 is looking at the market transparency, the tax environment, and the regulatory environment. So what is the supporting infrastructure for financial markets development? Do we have a tax system that is supportive of financial markets transactions? Do we have commitment to global standards such as the Basel requirements for banks or the IFRS standards for accounting? How is this information being reported? Is there transparency? Can investors access the information? Are there regular reports that financial institutions show? And also, what is the status in terms of the protection of minority shareholders? In terms of information as well, are there corporate credit ratings? Are the international ratings agencies present in the country? What is the regulation around this? So there's quite a lot of indicators in this pillar. And what is notable also is that this is a pillar where overall we see not as much variation. So as you can see in this chart, most countries score quite well. It's pillar 3 and pillar 5, as George will explain later, that have the highest average scores in total. So the infrastructure is there. And what we see in the index as a whole is that, yes, the infrastructure is there, the tax environment, the transparency, the market regulation, but how do we actually get this to translate into higher scores in pillar 1, for example, which is market depth, or in pillar 2, which is showing interbank foreign exchange turnover and other indicators? So how do we make that jump? If we move to the next slides to look at who did well and why. So Morocco is one of the biggest risers, rose 6 places, and that was because of an increase in corporate ratings from international ratings agencies, and also made improvements in terms of the protection of minority shareholders. So there were 9 corporate ratings, which is a new high for Morocco since we started tracking this index. And Kenya also improved in this because there were improvements in terms of the corporate governance structure. The Kenyan Capital Markets Authority issued guidance to allow firms to purchase their own shares, and it also started more coverage from local ratings agencies. Similar story in Uganda, where we saw more corporate ratings, and also survey respondents said that there is more capital market development policies from the capital markets authorities. Other notable developments is Angola, where we saw the first tax treaty signed with Portugal that came into effect in 2019, and it's now one of the countries, along with everyone else, that has at least one double taxation agreement. And finally, large corporates in the Seychelles are gradually taking up IFRS accounting standards, and Ethiopian banks have until the end of 2021 to transition to IFRS. So these are some encouraging developments in terms of the market infrastructure. And overall, it is a pillar where we see a higher average than in others. I'll hand over to George now to take us through pillars 4 to 6.
Thank you, Danai. I will just look at pillars 4 to 6. And the first pillar really talks about capacity of local investors. And as mentioned earlier, it's really looking at the capacity of pension funds within the market as measured to per capita, and also looking at the capacity of the size of the pension fund in each of the countries relative to how much government instruments and other securities are listed on the exchange. And this pillar really recognizes 2 important facts. One of them is that having a strong local investor base, particularly reflected in the size of pension funds and their activities, is a source of capital provision, particularly long-term capital, and also serves as a shock absorber for the market in times of volatility. And I think we saw in the presentation earlier. And if you look at the pillar results, you actually recognize that the top 10 countries are countries that have put in place reforms around their pension fund sector, and reforms that is really supposed to drive private sector participation in the pensions sector, and also reforms that tackles the issue of having a much more robust rules and governance around trustees, such that trustees perform their duties of creating value for funds. If you look at the top 10 countries within this particular pillar, you see that Namibia, for example, is doing quite well. And then you go to the extreme for countries that are on the other side. Now, for the countries that are in the top 10, as mentioned, one of the things you see is that these countries have put in place reforms that really drive a higher asset under management over a period of time. And then you can also identify that there is a direct correlation between having a strong local capacity and the depth of your market. So 6 out of 10 countries in the top 10 for this pillar will also feature in the market depth pillar, which actually tells you that really, if you want to develop a market, make it deeper, you cannot do that by ignoring the capacity of local investors. It is the pillar with the lowest score across board, and it's been since 2017. But we also recognize in the report that this has been the pillar that has been the fastest growing, attributed to reforms that are happening within the pension sector and the asset management sector as a whole. For the year, the pillar increased by a score of 3.2, and we've seen that more and more countries are actually doing a lot around developing the capital market as far as local investors are concerned. You also look at the top risers, which are Namibia, moving 3 places, Egypt and Mozambique. The story of Namibia is actually quite interesting, where there is a deliberate action by local authorities to actually prop up the depth of local markets by actually encouraging asset managers to invest more in the local capital market. That rule has come into effect, and we're beginning to see the effect of that come through quite strongly. Egypt is the other one, and then Mozambique is also seeing their assets under management for pension funds increasing quite aggressively. The top 4 lists are Cameroon, Angola, and Zambia. And particularly for Angola and Zambia, it is really as a result of assets under management declining significantly. And it's already been mentioned, these are countries where currency have devalued or depreciated by more than 40%. And immediately what that means is that it translates into lower value for anyone with investment in the pension sector. So can we move to the next page? And it's really, the next page really tells the story of Namibia and some of the measures that have been put in place that are really driving the pension assets under management growth within the Namibian market. Namibia, I mean, on the first score, has the highest pension fund asset under management per capita, and it's really leveraging this high score in driving development in the local market. It also saw a significant growth in terms of pension assets under management, attributed to a strong performance within the local market. And then you look at, again, the extreme side, and then you have countries like Mozambique, Senegal, Angola, that need to put similar structures as Namibia, Mauritius, Botswana, South Africa, who are leading the pack, similar structures in place to be able to drive a stronger capacity of local investors and be able to buffer whenever there is volatility in the capital market. If you look at the next page, it really talks to other specific examples of developments that are happening across the continent as far as local capacity is concerned. We believe from the report results that one of the things that needs to be focused on, if you look on the next page, one of the things that needs to be focused on is the continual reform within the pension sector. It's also important that there is a lot of focus on the role and activity of trustees, that they become more activists and grow value compared to what is currently happening. And then the markets need to leverage on the strong payment structures and financial inclusion to really drive savings across board. And that really will bring transformation in the capital market for the continent. On the next page, we talk about Pillar 5. And Pillar 5 talks to the macroeconomic opportunity on the continent and measures things like GDP growth, living standard growth, and absolute export market share, the quality of banks, the quality of the debt profile of each country. It talks to market transparency and information that needs to be given to market participants to be able to make informed decisions around the financial market. And the other side of it is to recognize that no financial market can develop without an underlying stability in the macroeconomic fronts. And that is really what this pillar talks to. And you can see that it's one of the pillars with a very broad-based good performance across the continent. And it demonstrates that from an Africa perspective, the macroeconomic opportunity is real, right? Aside that, there is increasing transparency from government and policymakers, regulators, central banks perspective to make data more and more accessible to investors. If you look at it, I mean, the top performers, South Africa, Egypt, Botswana, Mauritius, and Morocco, have all put in place reforms that is making data more transparent. And another critical component which is emerging as you read the report is the fact that more governments are going into the issue of putting risk management policies in place to manage particularly external debt, which for Africa has become a significant issue at this particular point in time. You also recognize that over time, I mean, this pillar used to be one of the high rises per year, but COVID has had an impact, and the growth for this pillar has been quite muted this year. And it will be interesting to follow developments in the future as the effect of COVID actually run through the various economies. Top risers are Mauritius, Ivory Coast, South Africa, and then the countries that decline, Rwanda, Ethiopia, and Cameroon. If you move to the next page, it talks a lot more explaining the previous page and highlighting some of the developments in specific countries. Ivory Coast, a very good growth story, which has been quite consistent. And the other thing you identify with Ivory Coast has been the resilience of the market or macroeconomic development to the impact of COVID. So it's one of the countries that keeps projecting very high growth rates into the future. It is important going into the future and into the next result, some of the things that needs to probably be focused on as a means to develop and grow this pillar more and make it information accessible to investors. Some of the things investors will be looking at, of course, will be the headline growth at the macroeconomic level. There's also going to be a bit of focus from a banking sector perspective, because that is measured here in terms of what is the impact of COVID on NPLs in banks, for example. There's going to be increasing worry or increasing concern from investors around the debt profile in a lot of our markets, and investors will be asking a lot of these markets what structures are being put in place to ensure that the debt profile improves over time. The last pillar talks to legality, and which is on the next page, talks to the legality and enforceability of financial market agreements. And here again, it's really an important structure that really underlines the growth of any market. And the pillar talks to things like how strong is your legal framework, specifically highlighting the issue of whether netting is enforceable or not. If I post collateral against my transaction, is that collateral really mine? So really speaking to the issue of property rights within the financial markets. And as you can see illustrated in the pillar results, there is a big variance between the top 5 and then the rest of the pack. But the good thing is that there is a lot of development in terms of countries focusing on now building the right legal infrastructure to support financial market development. I would like to highlight again that the top 10, I mean, out of the top 10, 7 of them are actually also in the top 10 in market debt, which tells you the strong correlation between having the right property rights in really driving the performance or the accessibility of financial markets. The top risers are Ghana, it's been mentioned, Zambia, Nigeria, and then the countries that declined were Namibia, Angola, and Kenya. And I would like to stop there and say that a lot of the decline particularly for Namibia, Angola, and Kenya has been as a result of data quality. And what we've had, and Jeff mentioned it, is the involvement of internationally recognized institutions like Absa joining the index and really helping to drive the right outcomes for the index, as compared to previously where it was an opinion of market participants. And the good thing also is that the opinion or what has been stated by ISDA corresponds directly with what the legal environment or the legal fraternity in these countries are saying. So if you go to the next page, which highlights, and the concluding page highlighting the significant developments, you see Ghana, which comes in quite strongly, 5 points to a 5th place, and steps were taken after the last publication, and the central bank governor actually confirmed that they look at the results and decided to put in place structures to ensure that they come up as one of the top countries from a legal enforceability perspective. So netting is now clean in Ghana, and the documentation rolled out across the country. Nigeria followed the same kind of direction, and they've put in place structures to make sure that they have a stronger legal framework for financial market transactions. If you move to the last page, it really talks to the a snapshot of what is this view or what the survey view is across the different countries. Fortunately, unfortunately, we have 5 countries with clean netting enforceability opinions. And the good story is that a lot of countries are in the process of actually taking their legal frameworks through the same process to arrive at places where Ghana, Mauritius, South Africa, Nigeria, and Zambia have actually got into. So to end, we just want to thank all regulators, the central banks, the stock exchanges for their commitment in providing data. We only hope that into the future, the data will be better, and this result will really help in focusing and ensuring that policymakers actually hit the nail right on the head when it comes to financial market development. So on that note, I would like to hand over back to David. Thank you very much.
Thank you, George. Thank you very much, George. Yes, you can see, ladies and gentlemen, listening to this around the world, what a lot of granularity and detail there is in this report. I think it's even more than usual this year because we've been hit by this crisis. But on the other hand, there's been a great deal of underlying development going on. And I must stress that for anybody who's got any questions about this, you can certainly ask some questions on the chat function now, which is open, but we may not have time for all the questions. So please do send in emails, do send in anything that you'd like to know about the report. We are only too happy to help, and all my colleagues here will answer all the detailed questions that there are. But I'm sure we'll have more questions than we can possibly answer in the remaining time. And we know there's hundreds of people on this call, and we really do want to get this going. Now, I want to hand over now to Jing Dong, who I mentioned before. Jing Dong is the Treasurer and Vice President at the World Bank Group. He's been there now for a year and a half, and he's had a wonderful career, actually, being Treasurer at nearly every large development organization you can think of. He was at the African Development Bank, Asian Development Bank, and of course, for many years, where he really made his name as the IFC. Some of the things we've been talking about, development of local currency markets, Jing Dong, that's been part of your stock in trade for many years. You've accompanied the growth and the development of African financial markets. Please let us have your thoughts about this year's report and what we have to build on. But before we do that, I want to just ask the same question again for the audience. I just want to test whether or not you've changed your mind. We had 82% of people thinking it had fundamentally altered the investment outlook, and we had 18% saying no, it hadn't. Please just to put down what you think now. Forget what you said before. Tell us now whether you think the COVID crisis has fundamentally altered the investment outlook. That will maybe tell us whether or not uncertainty has gone up or down in the course of the last half an hour during the presentations. So please fill in your scores, and then we'll go over to Jing Dong immediately after that. And you can actually comment on that, Jing Dong, when you see the scores coming up, because you'll have something real live to talk about. And then we'll go into the panel discussion with the other discussants. So please, can we have the results now, please, organizers? So uncertainty has gone down by 5 percentage points. Jing Dong, I've introduced you already. Over to you, please.
Well, thank you very much, David. Let me do a sound check. Can you hear me all right?
We can, yes.
David, thank you again for your invitation, and thanks to Absa and UNFIF for doing this wonderful index. And I was very honored to be associated since the beginning. You know, indices can be a great tool to motivate countries and individuals to change. Just look at the college ranking in the United States that motivates so many young people to, you know, to work hard, to study hard. So David, let me say that I was a little displeased that I couldn't vote myself, because if I had voted in this poll, I definitely would be in the minority, because I strongly believe that it has not changed the fundamental outlook, because our commitment to the SDG goals has not changed. But of course, this has introduced a new element where it reminded us that any development that we do has to be sustainable, inclusive, resilient. So this is the new element on resilience and sustainability. I think you know, this COVID-19 has introduced. I'm cognizant time is short, so I'm gonna be very brief in opening up, and then happy to join the panel for a more interactive discussion. Number one, I want to take this opportunity to congratulate Governor Amnali to now lead Absa, and I think Governor has been a force in overseeing the central bank's a critical role in ensuring financial stability, and so on and so forth. You know, the World Bank Group, especially the World Bank, when we enter into financial investment in South Africa, many of our investment with South African state entities, you know, they have been converted to local currency from day one, and that's great financial management. You know, very important for volatility as we experience now. So a couple of things. The first is I wanted to say is that this COVID-19 certainly is unprecedented, at least for the last 100 years. And I'm very proud the World Bank Group has done our part in coming up very quickly with an ambitious package of 160 billion across the World Bank entities to support the immediate need, but also the recovery down the road. And for Africa, that package is about 50 billion, very much needed financing, because you know, as the panel talk about the Africa government's ability to tap euro-dollar market, that market has ceased. Commodity price has dropped, and that deprives the African government another source of revenue. Remittance has dropped. So all of this pointing out the very, very important need for the World Bank Group and multilateral systems to ramp up, scale up our support in this critical time. The second thing I wanted to mention is that you know, this new index this year certainly has pointed out some progresses, but also some gaps that we continue have to be addressing. And I remember one year the African Bank had its annual meeting in Busan, where I wanted to draw a bit of parallel. As late as 1997, which is not that far ago, South Korea had no local currency corporate bond market. It's actually zero, because South Korea, you know, was relying on the model of borrowing dollars. And we know what happened in 1997 when the Asia financial crisis hit. But fast forward to now, South Korea has a local currency corporate bond market that is 80% of a $1.6 trillion GDP. And that's the progress that that country has made. And we can talk about Thailand, Malaysia, and of course, China that made similar journeys in using domestic capital market, tap into domestic savings as a primary source of financing both government debt and corporate debt. So I think this index certainly draws very heavily on the relative size of the market. And I think East Asia provides a great example of the hope and the potential that Africa continents can hope to achieve. And certainly right now, the index covers about 25, 23 countries. hopefully in future editions, all Africa countries would be covered. I think that's one thing I would wish to happen. So next thing I wanted to mention very briefly is about sustainability. I'm very happy that the index now has included sustainability. As you know, the World Bank Treasury has been at the forefront of advocating for ESG inclusion, both on our liability side, and as we are the first green bond issuer, but also now on the fixed income investment side. I think the early introduction of the concept of ESG and sustainability into the index is a great thing, and hopefully this would actually lay a better starting foundation when capital market develops in Africa. So sustainability is at the core from the very beginning. Talking about sustainability, one capital market instrument that we pioneered and experienced, which I think is also another element that can be added, is really how do we use capital market to solve the financial challenges due to natural disaster. That is, could be earthquake, hurricane, drought, so on and so forth. I think, as you know, the World Bank has been issuing CAT bond, catastrophe bond, and that is an important element or capital market instrument that can fold into this. So that's another angle I wanted to mention. So let me close, David, by saying yet again that capital market development in Africa is critical and fundamental for Africa continent to achieve its full economic potential, because the primary source of financing for any country's economic development has to come from recycling and connecting domestic savings. And you can't really do that building a vibrant, deep, liquid, well-regulated capital market. And therefore, the joint effort by Absa and UNFIF is really, really terrific. And the World Bank Treasury certainly is very happy to be involved in this. So with that, David, back to you.
Thank you very much, Jing Dong, and thank you also for your support for this index that you've now been given for the last 3 years, and I'm sure that this will continue. And thank you also for staying on to be part of the panel. I can now open the panel to our panelists from around Africa who can be discussing some of the findings of the index, but could also be talking about the impact on their own countries. We are running a bit short of time, and I'm going to ask unilaterally whether we can extend the panel by maybe 10 or 15 minutes, because there's so much to say. And you can see by the presentations that we've had that there is just a huge amount of detailed arithmetic to go into. But first of all, let me just introduce the panelists. You've heard Jing Dong already. In the order in which they'll speak is Havesh Sigulam, who is the governor of the Bank of Mauritius. As we heard, Mauritius, as it is every year, is always up in the top 3. But in fact, what we're looking for so much is not the absolute positions, it's the positioning vis-a-vis those who are coming up and those who are coming down, also what countries can learn from each other. I'm hoping that Sheila Mimbijwe will be there. She's the Deputy Governor of the Central Bank of Kenya. We heard a lot about Kenya, and therefore we'll be going into the details about Kenya as well, but also the East African region in general. And then we also have William Lugemwa, who is the Director for Private Sector Development and the Financial Division at the United Nations. So you're in Joburg at the moment. You can talk about the African continent as a whole. First of all, Havesh, there's a question from the audience that's come in already, actually, and I can put to you, but you can maybe put this also in relation to what's going on in Mauritius. The questioner from the audience says, does this index tell us anything about the resilience of Africa as a whole to the COVID crisis? Perhaps you can answer that question, Havesh, please, by talking about what's been going on in Mauritius, how you've, from a financial market point of view, been trying to shore up the defenses of the country against the COVID crisis, and also what can other African countries learn from the Mauritius example?
Thank you, David. And at the very outset, allow me to commend both UNFIF and Absa for this laudable initiative about the index. It does come at a very appropriate and opportune time when dynamics are. We've all heard what is happening. Yesterday, I think most of us took cognizance of the contents of the World Economic Report also. So we all are in the midst of unprecedented times, and we all know that dynamics have been changing and will be changing also going forward. And in such uncertain times, what is very important is to keep confidence at the highest level. And the only way you can keep confidence at the highest level is to ensure that there is resilience in the financial markets and there is resilience in this banking, basically. Now, I must say, it's a very interesting question that you have got from the audience about resilience and the importance of it in ensuring that we can keep the momentum going. But before I take the deep dive into resilience itself, I think what is very important to note, and this is something that I'd like to draw on very quickly on what Tobias mentioned, in his initial talks that he made earlier today. It's about ensuring that the sanitary crisis that we all have lived in the recent months, which have now turned an economic crisis, do not turn into a financial crisis. And the only way in which we can ensure this is by ensuring that we do have a financial market that is really, really resilient to all that has been happening. And when you look at what the merchant case has been so far, and in many cases, I must say, it is many of our African also, it's about the effort and the energy we've been putting over the last few years in ensuring that there are three fundamental pillars that are being developed at the same pace. The first is all about developing the infrastructure that support a resilient financial market. The second would be certainly the most important component, being the regulatory, the legislative, the doing business, and the fiscal environment that accompanies these developments. And then certainly then on the third angle, there would be the market access. How easy is it really to access all these financial markets? And I must say that over the years, we've noted very significant progresses that have been made. And we continue on acting on such initiatives that would allow us to grow further on this path rather. In Mauritius, we've been putting a lot of efforts in ensuring that whatever initiatives are being rolled out in such a manner that it is done in a very consultative way. By this, I mean that there's a lot of discussion happening both between private sector operators and the decision makers and the policy makers in terms of ensuring whatever is being rolled out as strategy actually produce the desired result. And this has been for us a very good factor that has explained how we've been progressed and how we've been able to ensure that resilience so far in our financial markets. Another very important thing is about the determination about both broadening and deepening the financial markets. And again, if we look at how our financial markets have been evolving over the years, you would see that there have been a very equal importance given to both deepening and broadening the offering of the financial markets. The latest one are actually contained in the report itself. I'm not going to dwell too long on them in the interest of time that we have here. But I must say, like, for example, the stock exchange of Mauritius have now, amended their trading rules so as to allow them to join basically the ICSDs. Basically, this brings in the added comfort. This brings in basically the type of comfort and the type of innovation that international investors would be looking at. At the same time, we're rolling out the digital strategy that we talk about at the level of the Bank of Mauritius. Here, we've recently launched, the MOCAS, which is actually the payment platform that would enable all digital activities and fintech activities going forward. At the same time, we are adopting international best practices not later than September this year, basically, we've now accepted and adopted what we call the Global FX Code, basically, which is a code that has been developed by the BIS in consultation with many central bankers. So the mix of all these have contributed to having conditions, having an environment that has allowed the Mauritian financial markets to remain very resilient. And I can say that, you know, when I look at the index right now, over nearly half of, you know, the countries that feature on the index list have made very good progress. Altogether, does point towards the confidence that we all want to achieve in our financial markets. It does point towards the fact that people are interestingly and increasingly looking at the region. And I think we have no other alternative but to ensure that we all work towards achieving the same goal of having a more resilient financial market.
Well, thank you very much, Governor. I think you put the message very forcefully and very well. And we're looking at the continent as a whole here, not so much individual countries, even though the individual countries are extremely important. We can learn from that. Sheila, Deputy Governor, thank you so much for being with us from Kenya. I just wanted to make sure that you can hear us all right, and you are, I hope, also unmuted. So we'd like to hear from you, Sheila, about also the role that Kenya is playing in the general economic and financial market developments. Ken, did you hear that, Sheila, in Kenya?
Yes, I can hear you loud and clear.
Good. Okay, thank you very much. I'm not sure whether you were there for the beginning when we were talking about the general.
I've been here throughout. I've been here throughout.
Oh, good. So would you like to comment then on how you see Africa as a whole gaining resilience despite the awful ravages of this crisis? And also, what specifically can we learn from Kenya's example over the last 12 or 24 months?
I think I'm going to, well, firstly, I want to thank everyone and greet everyone. Obviously, plagiarizing a little bit on what has already been said. I think the topic that you have on your report is that Africa possibility is in the details. I would say that Africa's possibilities are in the details because there's so many possibilities. I think it's also true that indices like this are very important because we need to be data driven, but we need to understand how that data is brought together so that we know where to focus if we have a concern, or to focus if there's something that needs to be improved. So I'm very grateful when I see this. And I think in the future as well, there's going to be more need to look at inter-Africa comparisons. And if we have good indices that we trust, then that ability to look at those inter-Africa comparisons is going to be of great benefit to all of us who are in the position of policy and to all of us who are in the position of driving economies. I also want to make the point that although there are similarities across the African continent and the African economies, there are also great differences. And there's great differences in the nuance in different economies, the character, the size, the focus. And I'm always saying that we must expunge that concept of the African view, because it was quite misleading in the past and has created problems. I mean, for example, if you compare those African countries that are minerally based and those that are not, you're talking about quite different structures. And even when you're talking about those countries that are landlocked and those that are not, you're talking about very different countries. So it's very important as we go forward to make sure we expose those details. We don't just put a kind of a cover that doesn't actually define any of us. I liked what Jin Dong said about COVID. And I think that having been through the last 6 months of difficulties, it's really focused our economies on fundamentals. And he picked it up very nicely by saying protect the poor and the vulnerable, and support business and bolster economic recovery. I think that that is true to what most African countries are doing. And obviously Kenya thanks the IMF and the World Bank for their support in this period, which has been very important. And I also agree that the capital markets have a huge role to play in this respect. Even as we consider ourselves in our infancy, we have a huge role to play. The capital markets have a huge role to play. But we need to build back better. And I think this was also said by one of the other participants. Uncertainties prevail and risks dominate. And that's where we are right now. I was looking today, the IMF has released their October WEO. And when you look at the WEO report, you see it's quite positive because it was produced in the period July, August, and September. Now in October, when we're looking at the UK and France and the Netherlands and Spain, going back into quite tight and extensive lockdowns, you wonder if that report really captures the essence of the perceptions and maybe even the forecasts now. We need to be very careful on how exact we want to be at these difficult times. I was thinking about it from an almost spiritual perspective. I said, future precision belongs to God. We need to be careful. But returning to the issues of the indices, I think in the world of internet and digital processing, there's a lot more ability for more and more reporting, more and more indices, more and more structures being created. And we need to make sure that in order for them to have confidence and trust, that it's critical for them to become true reference points that people want to use for very many years as comparators into the future. I see that in this indice that we talk about extending it, which is good. But I would like to talk more about upgrading, improving, and modernizing. For example, there was a lot said, I think Jeff was the person who said it, about the ability to actually interrogate the report and to interrogate the indices and to interrogate. But this is coming after the report is released. It would be nice for regulators and others to understand better, how are these models created? How did they come to those decisions, so that we can understand well what we need to do to address any issue that has been raised in this respect. I was dealing with something very recently, and it was an indice that we were filling in, and it had something called invisible flows. And I remember being extremely concerned in a world of AML, CFT, and FATF. Why would anybody in a regulatory reporting position be reporting on invisible flows? And of course, we interrogated and we found out it was something to do with EU legislation and their definition of that word. And we also saw the difficulties of LIBOR, which hurt us all across the world. So what I'm really thinking and looking at when I look at this report is it addressing governance, accuracy, timeliness, and transparency issues in itself? That's what's being insisted from the market players and should be insisted. And we should improve and we should develop as we go forward. But is it providing that also to the market, so that the market, the people who are reading these reports and interpreting these reports can see where those values were coming from, where those decisions were coming from, where the interpretation was coming from. In closing then, I think because I've taken quite a lot of time, I think to see these African indices is very important, and I'm very happy to be here on this panel today and to support them. But for them to become truly credible and a true reference point of trust, then you need to also provide the same standards that are being demanded from the markets. Thank you very much indeed, David.
Well, thank you, Sheila. That's really very, very thoughtful indeed. And I know that all of us will be taking that into account. We do try to produce a two-way street, really, between the regulatory and the central banking and the governmental community and the markets. But we clearly do need to improve that still further. And I know that Jeff and George and Danai, when they start thinking immediately after this broadcast is over, they'll be talking about the fifth index. So they will take all your thoughts into consideration, and we will increase this interactivity. So that's been very, very useful indeed. And thank you for taking it so seriously. And we do want to feed into the policy making environment. We think we have done to a certain extent, but we can certainly improve that further. Now, William, you are the Economic Commission for Africa from the United Nations. So you take a look at the continent as a whole. As Sheila has said, we have to be aware of the vast differences between different countries. But in the short space of time we have, and I have managed to extend this now by 15 minutes, could you, but don't speak for 15 minutes, please, William. Could you just tell us in relatively few sentences what overall drawings, what overall conclusions do you take from this report in terms of the resilience and the structure of African financial markets?
I think I'll briefly thank the panel and the organizers of this webinar. We're looking at domestic fund and domestic savings and domestic mobilization of resources as one of the key ingredients that is required within Africa. We're looking at intra-Africa trade, and we're looking at the way we're going to be mobilizing African countries to trade amongst themselves and the trade across borders. Hence, the domestic market development is very important for African economies and African countries. We've looked at the development of infrastructure in Africa, and as you're aware, most of the infrastructure has been funded by foreign currency loans and debts, and that has created a lot of difficulties. Hence, our looking at the domestic mobilization and the development of capital markets within Africa, so that such critical infrastructure should be funded using local currencies as opposed to borrowing in foreign currencies. So it will be a very interesting element and a very interesting way forward to see how best we develop markets within Africa, and also to see how we build and develop the intra-Africa trade, which will depend, I think, entirely and mostly on the development of markets within the African countries. With regards to infrastructure, we still believe that if we are going to be trading between African countries, we need to mobilize resources within Africa using all the available domestic savings and available resources we have, so that we can improve on the infrastructure, which will improve on trade and which will also improve on the capital markets development within Africa. That is what I can tell you in brief. Otherwise, from our side, we're looking at a lot of initiatives to push for Africa free trade, so that goods can move between countries, and also the local currencies should be used in trading between countries. That's all I can give you at this point in time, given the short period in time, but we've got a lot of initiatives we are looking at with regards to bringing Africa together.
Well, thank you. And I'm pleased also that I'm sure there'll be the same interactivity with you as there will be with Sheila. Thank you for mentioning the question of infrastructure. I'd like to put that also to Jingdong Hua, also Peter Matlari, who's the Deputy Chief Executive. He's joined us as well. And Peter, I believe you kindly agreed to give us some final remarks, which will take place now in about 10 minutes, because we are extending the session because of the packing of detail that we've had. But Jingdong, could I ask you about this infrastructure question, please? William has reminded us once again of the infrastructure needs of Africa. How can this specific report help? Because in fact, one of the questioners from the audience has said, is there a way of using the Absa report to tie in to countries' infrastructure needs and also to help investors gauge which African country is the best in order to develop infrastructure? What would be the best and most secure area for infrastructure investment in individual African countries? It's quite an ambitious question I've had from the audience, but Jingdong, would you like to take that question and try to develop it, please?
Yeah, indeed, David. I think we all know Africa faces huge infrastructure gaps, and I think that has become even more acute, that we now need to also focus on two elements. One is sustainability in terms of energy. The second is really digital infrastructure, the need to develop broadband, internet, so on and so forth, so that for the future, for a resilient economy, relying on a digital infrastructure is important. Can you imagine if this pandemic had happened 10 years ago? I doubt whether we could have had this conversation smoothly as we do now. Therefore, there is an urgency for digital infrastructure. Ultimately, I think I'll go back to East Asia example. That is, for the majority of infrastructure, in addition to government, providing that regulatory environment with transparency, with consistency, private sector and PPP have really to be the primary source of financing. So capital markets through attracting international investors and domestic investors. And this is where maybe I can give you a quick example. A couple of years ago, we worked with the Egyptian government in terms of how can we work together to introduce renewable energy in a way that is not piecemeal. And therefore, this project was very interesting in the sense that the World Bank worked with the government in terms of setting up a reform mechanism so that a power purchase agreement is created that is transparent and open to all private sector players. And then working with MEGA and IFC, I think we bidded out 13 solar farms in one go. That I think, if all done, will provide 1,600 megawatts of clean power in Egypt. And I'm very happy to see that it was done in one go, with a lot of private sector investors coming in through syndication by IFC, MEGA providing $200 million political insurance, and the World Bank advised the government, provided financing for the government to do the regulatory reform that is needed. And that, I think, indicated that that when you have a package of reform and a financing that is done transparently, consistently, you can attract international investors. The current stage of development in bond market, which is critical for project financing, is not at a stage that could sustain large-scale infrastructure finance and purely rely on domestic resources. So that's the journey that we need to travel. But meanwhile, how do we make sure that the package could be done with PPP, with multilateral development bank, with international players, institution investors coming all in? I think that's one direction. And as my colleague from UNICA had indicated, the Africa Continental Free Trade Agreement is, I think, certainly a very good way in boosting the attractiveness, because a connected Africa provides intra-trade opportunities and really boost employment, boost economic opportunity generation as another attraction. I just hope that we can, because the international community and African governments are still focusing on the acute challenges caused by a pandemic. But I think it is really the index, is this kind of conversation we're having, that is, we don't lose sight of the medium long-term goal that we have to put trillions of dollars and its local currency equivalent in financing that infrastructure. One additional point I want to make is that many people don't realize, I think is this one thing that we address as World Bank Treasury, is that food waste is actually a very, very big issue. I think food waste not only causes economic losses that can be rescued, but it has a strong link to infrastructure. It's really said by selling our SDG bonds addressing food waste that I myself learned that food waste is actually the third largest emitter of carbon after energy and transport. And therefore, this is an urgent issue. So some of the quick wins of reducing food waste is really by building great infrastructure, from cold storage to highways that can shorten the distance of transport. So I think everything links back to infrastructure and infrastructure financing But
thank you.
given the time, let me just stop here, David.
Thank you, Jing Dong. I mean, there's nobody better than you at marrying together so many themes, and that is something that we will have to reflect on, all those different issues, particularly the link between food waste and infrastructure. Since we are in danger of running out of time, even the extended time, I'm just going to ask each of the panelists in the order in which they've spoken. It'll be Harvish, and then Sheila, and then William, just to say, perhaps in 1 minute, if you can, the one big issue that you've got on your mind in terms of reforming the structures of the markets that you are responsible for, or that you are looking at. In the case of William, that will build a bridge to Peter, who will say some closing remarks. Between that, I also have one more polling question I'm going to put right at the very end. But first of all, Harvish, in just 1 minute, please, the one big regulatory issue that you've got on your plate in Mauritius right now that you're going to concentrate on for the next year.
I think there are three main regulatory issues. Very quickly, I'll just draw on very quickly. The first one remains all that is anti-money laundering. I think Sheila briefly touched on that. International compliance, FATF standards. This is something that, you know, in Mauritius we're giving equally very high importance, and we're making a lot of progress basically on strong fundamentals that we already have in the country, but we are further improving the offering. The second and the third basically focus would be on sustainable finance. This is something that we're working very hard on, building the regulatory framework, enabling framework to move more towards all that is green and blue financing. And then the third aspect would be the digital journey that we've embarked on. The digital journey ranging from digital banking products to digital systems that would support more financial inclusion through digital means. And I think these three issues would be key issues that would need to be addressed by all African countries in the region, and we're looking forward to working very closely with all African countries in addressing these issues.
Thank you. Sheila, what would you say in answer to that?
Just to make it very quickly, I think the most important thing is that the biggest sector of our financial or the capital markets is the banking sector. And given COVID, we're looking at the NPLs, liquidity, the customers, cyber and digital. We must take these all safely and stably across the line. And obviously none of us know where this post-COVID line comes. Thank you very much.
Thank you, Sheila. William?
From my side, I think the issues have been raised. It's mostly liquidity. We are currently looking at liquidity issues of banks and financial institutions in Africa, but also more important, the compliance and regulatory issues. But critical and what is coming ahead these days is the digital and the innovations in finance. Those will be the three critical ones we're looking at. Thank you.
Well, thank you. That's also very useful, I think, for putting together next year's report. There have been a lot of questions from the audience. We've not been able to go through very many of them, but we will answer individually all those who've been asking questions. So we will come back to you. I think Peter is there. I hope he is. He was on the screen just now, and then he's disappeared. But just before we go to Peter Batlari, the Deputy Chief Executive of Absa, we have got one more poll, which I'd like to put on the screen, please. And this is a political question, and it relates to a certain event taking part in a place, large country, on the 3rd of November. So would a Biden or Trump presidency be more beneficial for Africa in the longer term? I would say in the next 5 years. And so you can answer Joe Biden or you can answer Donald Trump. Who would be best for Africa? So a little bit of a teaser for you right at the end of this session before I will hand over to the closing remarks. So please, let's have your views, please, audience. And we look forward to hearing what the result is. And I'm sure it'll go straight through to the White House as well. So do we have the answer, organizers? Well, that's a pretty strong majority. No doubt people are not saying that they want Joe Biden to win or they even think he will win, but the overwhelming majority of our panelists, not the panelists, sorry, the audience, the panelists are not allowed to vote. Overwhelming majority of the audience all around the world think that Joe Biden would be good for Africa. So I hope we can feed that back to his campaign headquarters in the basement of his house in Delaware as soon as we possibly can. So I'd like to sum up by simply saying I wish we'd had another hour and a half, because it hasn't been long enough to go through what an amazing multiplicity of questions there are. There has been a lot of granularity here, and the devil is very much in the detail. Can we see whether Peter can be on screen to say a few words? And I do hope that you are there, Peter. He's got a technical issue, and so he's going to be with us, I believe, in just about 1 minute. We've got a very good picture of Peter here to show us what he looks like. Peter, are you on the line? We're looking forward to your remarks. So what I want to say in relation to Peter is that when we produced this report, I think it was 2 years ago, he said that this was like a toddler. Peter, I'm just giving you the introduction. I believe you said, Peter, there's something wrong with the way that we can't hear you, unfortunately. I don't know whether we can sort that out, or if anybody's an expert at sign language here. I think this problem may be something that we cannot somehow resolve in the short time with us. No, Peter, maybe Jeff, you could say a few closing remarks on behalf of Peter. You know his mind very well, I'm sure. I was saying that Peter said 2 years ago, this is like a toddler. It's like a child that is just growing up and learning to walk. Well, we're now 4. We've done 4 of these reports. Jeff, you could take Peter's words and take them forward. When is this going to grow into a teenager? When is this report going to start to stay out at night and throw its weight around?
Yeah, well, let's hope it doesn't become a teenager and start causing everybody trouble for a few years. Let's hope we capture the excitement and energy without the disruption. So first of all, to all of the panelists, thank you very much for the engaging discussion today. I think there were some superb takeaways there, challenges in the appropriate places, and also sort of recognition in some ways that the index is doing exactly what we wanted it to do, and that's about generating discussion, thinking about ways to improve the financial markets across Africa. And I think all of us reflected on just how important that is. That's been true in the first 3 editions, but as we sit here in a very difficult 2020 and think about the ways to rebuild our economies in the periods ahead, nothing could be more important. So to all the panelists, thank you very much. Of course, to everyone who's joined us, it's not quite the same, not being able to be front and center, to see people directly, to be able to engage. Inevitably, what should be happening now is we could be slipping into the anteroom to have a cool drink and to really pick up on all the topics that we're so passionate about. But as you mentioned, David, we'll take a look at the feedback and the question that's come in and look to address all of those so that no one misses out. And then lastly, I suppose, but not leastly, to everyone on your team, David, at OMFIF, who's worked so hard to make this report the quality product that it is, to everyone that's assisted with gathering the data and the participants from across the continent who's given their time and energies, thank you. And of course, for my colleagues at Absa, it's something that we're very proud of. It's 4th year. We look forward to doing it time and time again. Again, the overriding message is it mustn't end today. It mustn't wait until 12 months from now. It's sort of the discussions, it's the interrogations, it's the learnings that are most important from this, and that should be a 12-month process. Thank you very much.
Thank you, Jeff. And I'd like to also say that this is a toddler that's becoming very active, and it's a very inquisitive toddler. It's going to ask questions. We want feedback, we want guidelines, we want people to tell us where we think we can improve. Peter, you've been such a supporter for this. You are very eloquent even when you're not saying anything. So goodness knows how eloquent you are when you're actually speaking. We miss seeing you in the flesh, but we look forward to continuing to have this virtual discussion with you until we can all meet again. So thank you all the panelists. Thank you, Sheila. Thank you, William. Thank you, Havish. Thank you, Jing Dong, for being with us. Danielle, right at the beginning, setting the scene. Thank you for George and Jeff and Danai for taking us through the presentation. Please download the presentation, ask questions, come back to us, and then we look forward to seeing you at the latest next year. Thank you all very much indeed for being with us. Goodbye.